Like I said, that's Carlin's Online Academy, and in the series of videos, we're learning how to solve these 6-mark cash flow statement questions that are asked in the examination. And in the previous videos, I taught you what working notes we got to prepare and how to prepare a couple of working notes. And in this video, I'm going to teach you the third working note that you got to prepare. This is almost these are working notes that are almost have to these are working notes that have to be almost prepared on all questions. Sometimes you might not have one of these adjustments, and if they're not there, you don't have to prepare them. But this one is particularly have to be something that has to be prepared in all the almost all the questions. Okay, so that is calculation of net profit before tax and extraordinary items. There are two ways of calculating preparing cash flow statement: the direct method and the indirect method. The direct method is not part of syllabus for CBSE grade 12, but the indirect method is. And in indirect method, we start from the profit earned during the year, and we work out to find out the cash flow from operating activities. So in the indirect method, the starting point of the cash flow statement is calculation the net profit before tax and extraordinary items, and how to calculate that is what I'm going to teach you in this video. And how to do this working note with the information given in the question is what I'm going to teach you in this video. Now, what are direct and indirect method, I'll teach as part of the theory videos, which I would be uploading in a couple of days. The knowledge of that is not required for understanding this, so you don't have to worry about it. Before we actually jump into the working note, I want to give you a basic understanding of what we're going to do that, for which I'm going to do certain things. I mean, what I mean is I'm going to teach you something which might help you. I'm going to teach you how the P&L account actually looks, okay? From the point of understanding this working note, okay? So usually you have the sale or revenue from operation. From the sale or revenue from operation, you reduce the operating expenses to arrive at the operating profit, and from that you reduce the non-operating expenses and add the non-operating income to arrive at the profit before tax and extraordinary items. From that, you reduce the extraordinary expenses, which usually are, loss due to fire, earthquake, theft, or any other abnormal extraordinary item which do not happen in every year. And you add the extraordinary income which might be insurance received against the above losses, or government subsidy given during that year. Those things. You get profit before tax. From that, you reduce the tax, which is provision created during the year for the year, to arrive at profit after tax. Now, from profit after tax, what happens? You appropriate whatever amount you have decided to set aside as reserves. So you transfer a certain portion of profits to reserves, and then you pay dividend to your shareholders. Dividend might be interim dividend, final dividend. And whatever amount is left after that is taken to your balance sheet. And under reserves and surplus, you have statement of P&L or P&L reserve, closing and opening. This amount that you earned during the year is added to the already existing opening to arrive at the closing balance of statement of profit and loss. I wanted you to understand how this happens in the P&L account for you to understand the working note easily. It will help you understand how to prepare the working note, and you will not miss any items if you have an understanding of how the number flows from sales to the reserve in the balance sheet. Now, if you see, what they will give us in the examination is this. They'll give us a balance sheet, and they would have given the opening balance of P&L reserve and the closing balance of P&L reserve, and they would have given these information as additional information or indirectly. What we have to do is we have to work backwards, go from here, and then go there, go back, go back, go back, and arrive at our profit before tax and extraordinary items, which will then be the starting point of the cash flow statement that we prepare for the 6-mark questions. Understood or not, my dear children? So how to go back is a question. Now I'm going to prepare the working note. Now that you've understood the P&L account, serial number. Here I'll give all the adjustments and what you're supposed to do with every adjustment given in the question. Particulars, amount. But all of these adjustments may not form part of every single question. Usually it is just 1 or 2 adjustments. But I'm just giving all the adjustments so that you'll get an understanding of this. Okay. The starting point of this working note will be the closing balance of your P&L reserve. Closing balance of P&L reserve or closing balance of statement of profit and loss reserve. That is from your balance sheet. This number, particularly this number, this one, this one. Okay. So the closing balance of P&L reserve. From that, you reduce the opening balance of P&L reserve. You will be able to arrive at this amount. When you reduce, you arrive at this amount. So closing minus opening will give you this amount, because opening plus this amount only gives you the closing, and therefore when you're working backwards, it's closing minus opening, and you will arrive at this amount. Now, what is the first thing that is added after, before transferring to P&L reserve? You reduce dividend and the amount is transferred to the balance sheet. Am I right or not? The next thing that you got to do is add the dividend amount. Now, dividend, we'll have interim dividend and we'll have final dividend. Final dividend might include equity and, both interim dividend and final dividend will include equity and preference dividends. What is the difference between interim dividend and final dividend? Final dividend is the amount of dividend paid to the shareholders at the end of the after the end of the financial year, after the approval of all the shareholders. Now, how dividend is paid is, assume this is the financial year. At the end of the financial year, the board of directors of the company will prepare the financial statements and they shall propose a certain percentage as dividends. Now, after the end of the accounting year, in the next accounting year, within 180 days, the company is supposed to conduct an annual general meeting. And in the annual general meeting, the shareholders will vote on various resolutions that have been passed. One of the resolutions they'll vote on is the amount of dividend to be paid for that year. So the directors propose a certain percentage of dividend, and if the shareholders agree with that, they will vote for it. If the shareholders don't agree with that, they will discuss about that, and they might declare a different percentage of dividend. So whether a certain percentage proposed by the shareholders on 31st March of that year is declared as dividend in the next year or not is not a surety. It is a contingent liability. Proposed dividend is a contingent liability. It's not for sure that this percentage will be declared by the shareholders. So for whatever profits earned during the previous year, in the current year, the shareholders will vote and declare the dividend. And the declared dividend will be paid within the next certain number of days, according to the Companies Act regulations. Okay, my dear children. So what dividend will get paid in the current year? The previous year dividend. Am I right or not? Am I right or not, my dear children? So this final dividend is the previous year dividend. In order to confuse you, in order to confuse you, they'll give you both the current year proposed dividend and the previous year proposed dividend. But what is required for the current year, what is paid during the current year, is the previous year's proposed dividend. So when you're preparing the cash flow statement, you got to consider the previous year's proposed final dividend and not the current year's proposed final dividend. While solving the question, you'll get a better understanding of that. Now, interim dividend. What is interim dividend? Usually, the final dividend is paid after the end of the year. The directors propose and the shareholders vote, and then the dividend is declared. Right? If the articles of the association of the company provides, and the company has been declaring dividend for the past 3 years, 5 years, I think, 5 or 3, according to Companies Act, but that is not part of the syllabus. If the company had been paying dividends continuously, final dividends continuously, then the board of directors have the authority to declare a dividend based on their quarterly results itself. They need not wait for the shareholders' approval. For this year's profit, this year itself, the board of directors can declare dividend and pay the dividend. So it is paid during the year. Interim, based on the interim reports, the dividends are declared. Therefore, those are interim dividends. Understood or not? So which interim dividend is relevant? Current year interim dividend is relevant. Understood or not, my dear children? So current year interim dividend and previous year final dividend will be paid during the current year and would have got deducted from the P&L account. So when we are working backwards to find the net profit before tax and extraordinary items, we find out the amount of profits during there, and to that we add the dividend which has got deducted, and the dividend that has got deducted would be the interim dividend of the current year and the proposed dividend of the previous year. Final dividend, we are talking about the proposed dividend of the previous year. Interim dividend means the current year interim dividend. Understood or not? So we add both of these numbers and add it to our figure in the outer column. Understood. Now dividend to preference shareholders is paid even before the dividend to equity shareholders are paid. That is why they call preference shares. They have preferential right over dividend and repayment of capital. So if the question mentions that proposed dividend is 10%, it is not only on the equity share capital of the company, but it is also there on the preference share capital of the company. Now, preference share capital, if they are 9% preference shares or 8% preference shares, and if the question says that the proposed dividend of the previous year is 10%, the 10% has to be applied on the equity share capital. And if it is 8% or 9% preference share capital, then 8% or 9% has to be applied on the preference share capital to arrive at the total dividend. While solving the questions, I will solve it and show you, so you will get a better understanding of that. Okay. For now, you just have to remember that even if the question doesn't mention anything about the preference shareholders, if dividend is paid to the equity shareholders, it is not possible for the dividend to have been paid to the equity shareholders unless and otherwise preference shareholders have been paid dividend. And therefore, we add dividend. When we are adding dividend, we add the interim dividend and the final dividend. The next thing is transfer to reserve. We add back whatever amount we have transferred to reserves. Understood or not? Transfer to reserves. How do we do that? We just do the closing balance of the reserve and reduce the opening balance and then transfer. Understood or not? So we'll take all the other reserves other than the P&L reserve. If it, for instance, general reserve, capital, general reserve, or any other reserve. If it is capital reserve, then you got to see if that reserve has come from the P&L account. Obviously, capital reserve will not come from the P&L account. Yeah. So general reserve or any other reserve which has been charged to the P&L account. You take the closing balance of that particular reserve, and then you reduce the opening balance of that reserve to arrive at the reserve that has been transferred from the P&L account to that particular reserve. And when we are working backwards, we add that back. How do we add that? Find the number. We reduce the opening balance of the reserve from the closing balance of the reserve and find the net amount that has been transferred, which will be added to the working note items in order to arrive at the net profit before tax and extraordinary items. So dividend reserves, and then we have tax. Children, I want you to be very careful here. What we add back here is provision for tax created during the year. Provision for tax created during the year. In the first video of this working notes, in the first video in which I'm, in the working note videos, the first one I taught you how to prepare the provision for tax working note. Am I right or not, my dear children? In that, we found out two items. We found out the tax paid and the provision for tax created. That provision for tax created is only deducted from the P&L account. And therefore, when we are doing the net profit before tax and extraordinary items working note, when we are adding that, we have to add back the provision for tax created. Understood or not, my dear children? We have to add back the provision for tax created. We have to establish what the provision for tax created amount is. And in order to do that only, I taught you how to do that working note for provision for tax. Am I right or not, my dear children? So we have to add that back. Understood or not? Not the tax paid, not the previous year, current year, not like that. The provision for tax created during the year, how much is that? We have to find that out using the working note, and we have to add it back. Understood or not, my dear children? So we add that back, and then we add, sorry, we reduce any tax refund that we have received during the year. In case we have received any tax refunds, that would have got added to the P&L account, and that will be reduced, my dear children. Understood or not, my dear children? So tax refund, anything that you have received during the year has to be added, subtracted, and then we reduce extraordinary income earned by the firm. Extraordinary income that has been credited to the P&L account, that also will be reduced. That also will be reduced, and we add back the extraordinary expenses. Extraordinary expenses will be added back, and then we'll arrive at the starting point of the cash flow statement, which is net profit before tax and extraordinary items. Understood on my, not my dear children? Now this might look like a big working note. You might not have to prepare the whole thing in every question. Only you'll have to include only those suggestions that are given in the question. As I told you before, it's not that difficult, my dear children, once you know how the number flows in the P&L account. As you can see in the P&L account, from the profit before tax and extraordinary items, they reduce the provision for tax, and you arrive at profit before after tax, and then they reduce transfer to reserves, and then they pay dividend, and the amount is transferred to the P&L reserve in the balance sheet. That is, it is added to the opening balance, and then you arrive at the closing balance. The starting point of a working note will be that point. The closing balance of P&L reserve, you reduce the opening balance of P&L reserve to find out the profit that got added during that year. And then you add dividend. While adding dividend, you've got to keep in mind interim dividend of the current year and proposed dividend of the previous year will be added back. When I say dividend, it includes preference and equity dividend. If they're given equity dividend and the company has preference share capital, then preference dividend will also be added back. So you arrive at the dividend amount, and then you transfer to reserves. Transferring to reserves, whatever amount transferred to reserve will be added back. Transfer to reserve amount, finding that out is very simple. You take all the reserves other than the P&L reserve, you add the closing balance of the reserve and reduce the opening balance of the reserve, and you arrive at the amount transferred to the P&L reserve. And then you add provision for tax created during the year. Remember, it is provision for tax created during the year. You have to find out what the provision for tax created during the year and add that here. I have taught you how to do that using the working note in one of the second video actually of this playlist. The first of the working note videos, the second video in the playlist. And then you reduce tax refund because tax refund would have got added in the P&L account. You're working backwards, so you reduce tax refund. Extraordinary income also you reduce, and you add back extraordinary expense to arrive at the net profit before tax and extraordinary items, which will serve as the first working note in your first item in your cash flow statement. This will be the starting point of your cash flow statement. With that, we've come to the end of this video, my dear children. I hope you understood. We'll be solving problems on this working note. A lot of the first few questions in T.S. Grewal book is also on these on this working note. You can go ahead and solve that also. I'll also solve some questions for you. And then in the next video, I'm going to teach you the format of the cash flow statement. I'm going to explain the format of the cash flow statement. And after which, we'll solve the previous year questions. Understood or not, my dear children? Please don't be intimidated. Once you get a proper understanding of this, all these working notes and the format of the cash flow statement and everything, this is like a cakewalk, my dear children. Cash flow statement, 6 marks, is like a cakewalk. It is there for the taking. You just go and take those 6 marks. Understood or not, my dear children? You people take care, have fun. If you have any doubts, please do comment. And that's it. Bye-bye. Take care. Please do share, subscribe, comment, all those things. Yeah.